Bourse report. I am Massy Holdings, manager of equities at Bourse Securities, and I'll be holding on for Cyril this morning. Today, we take a look at recently released financial results for two locally listed companies, Massy Holdings and Agostini Limited. These companies would have both released full year results for the financial year. We'll start off with, firstly, Massy, and take a look at their earnings and performance. Firstly, we'll see their earnings per share was down, continuing operations 16.3%, and from earnings inclusive of discontinued operations 13.5%. It's been an eventful and transformational year for the company, and that has impacted their operating costs, and you'll see that reflected in their performance. On the top line, the company continues to do very well. Earnings and revenue would have grown 10.8%. They would have benefited from a 19% year-on-year growth in the gas product segment, as well as a 10% growth in the integrated retail segment. Both segments would have benefited from recent acquisitions in St. Lucia, as well as in the US. Operating profit after finance costs was down 17.1%, as the company would have been impacted by some one-off and other operational and transformational costs and initiatives. The company would have done some prudential management initiatives as well. We saw an increase in the loan provisioning for bad debts of almost 100 million year-on-year, increase in interest costs from financing activities for the acquisitions of almost 80 odd million. And also they've sort of been impacted by one-off legal costs as well. So that would have impacted the operating performance of the company negatively. Profit before tax was down 7.6%. Year-on-year, the company would have benefited from the improvement in the performance of the associate companies and joint ventures, and the profit attributable to equity holders was down 13.6%. In terms of the performance of the segments, profit before tax, we see the two main segments continue to do very well, recording positive profit before tax growth over the 12-month period year-on-year. Integrated retail was up to 690 million from 654 million. Gas product segment was up to 356 million from 343 million. The motors and machine segment would have been impacted by the market and economic challenges of the Colombian market. The company would have had to do some increase in provisioning for bad debts, as well as some separation costs, and this would have impacted negatively the performance of this segment. Financials services segment was also down. In terms of the margins, because of the one-off and other operating costs, the margins would have been negatively impacted. You'd see the operating profit margin was down to 6.5% from 8.6% last year. Profit before tax margin was also down 7.2 from 8.7, and the current margin levels are almost marginally higher than what we would have experienced in 2020. Of course, these one-off and other operating expenses should not be repeated next year, and that should have a positive impact on the margins going forward. One very positive development for this company, and shareholders should be very pleased by this, is the transformation of the earnings of the company to a more regional, international driven. You'll see the earnings, profit before tax generated from the Trinidad market has fallen from 48% to 38% over the last 4 years. And profit before tax from the Guyana market has jumped to 24%. The other Caribbean countries, 31%. This would include Jamaica, Barbados, and the Eastern Caribbean. And the international market, US and Colombia, is up to 7% from 4%. So this is a very positive development for the company, and we expect this to continue, and the share of profits from the Trinidad market to continue to decline as the company continue to seek investments in the international market and transform the operations to a more hard currency driven strategy. Our recommendation for the security currently is market overweight. We do like the security PE valuation at 11.6. much better than the sector average of 13.5. Dividend yield 4.4, better than the sector average of 3.3. In revenue growth, we continue to expect healthy growth in the revenue for the company with recent acquisitions and continued focus on new acquisitions. And very positive development is the geographical diversification. In this environment, this is key to the success of many local listed companies, and the dividend yield quite attractive. So despite the challenges of this year, we do think the initiatives undertaken by the company is a net positive going forward, and in 2025, we expect better performance from the company. The next company we'll take a look at is Agostini. They would have also released full year results at the end of September, and the company would have been impacted by the net gain they would have recorded last year from acquisitions. Because of that, it would have negatively impacted year-on-year the performance of the company. The earnings per share was down 14.8% from $4.12 to $3.51. If you were to discount the one-off gain, which is approximately $64 million last year, the earnings per share would have risen around 10% from $3.12 to $3.51. The revenue for the company continues to grow, 8.7% up year on year. The company would have benefited from acquisitions in 2023 in the Bajan market and other regions, as well as acquisitions in the local market this year, as well as Curacao in the pharmaceutical segment. So the company continues to expand its regional footprint. In 2022, the revenues generated outside of the region, outside of Trinidad, was around 32%, and in 2023 was 39%. So we expect this trend to continue as well. The earnings outside of Trinidad Tobago to improve beyond the 39% and beyond. Operating profit was up 8.9%. Finance costs would have been up due to the recent acquisitions of 45 down. Finance costs up 45%. Profit before tax down 7% because of the one-off gain from last year, and net profit attributable to equity holders was down 14.9%. Profit before tax by segment, the company continues to do very well across all segments. Important segment, fast-moving consumer goods, have been able to double their profit before tax over the last 4 years, as well as the pharmaceutical and healthcare has also been able to almost double their profit before tax. The acquisition strategy the company has deployed over the last few years has been very transformative for the company and very successful. The energy and industrial holdings segment has also done very well. A smaller segment, but positive performance last year. This big 80 million figure here would have been impacted by the net gain on acquisition, and that would have been a one-off. The margins for the company continues to see improvement. This year we've seen it relatively flat year on year, but over the last few years we've seen definite improvement. The operating profit margin has grown from 8.1% 4 years ago to 10.2%. The profit before tax margin would have been impacted this year because of the one-off on a year-on-year basis, and it was down to 8.9%. In terms of their earnings per share and PE over the last few years, we've seen the company been able to improve its earnings per share, almost doubling it from $1.83 to $3.51. And with that, we've seen improvement in the share price as well. Over the last 3 years, the share price has jumped almost 94%. And as a result, we've seen an expansion of the multiples. 2020, the PE multiple was 12.8 times. 2021, it was 11.9 times, and it's currently 18 times. So the share price having jumped over the last 2 years, the multiples have expanded as well. This year, the share price has retreated a bit as the market overall has retreated. As a result, our recommendation in the security currently is market weight. I think the company's valuation is fairly valued on a historical basis, and even on a sector basis, the sector is 18.7. On a market basis, it's trading marginally higher than some of the other blue chip securities. So our recommendation is a market weight. The dividend yield is a bit lower as well, at only 2.4%, and the sector is 5.5. We do think there are some net positive going over the medium to long term for the company, of course. revenue growth. We continue to expect continued, if not double digits, at least single digit growth for the company, and acquisition. It's been proven very successful, and we anticipate further acquisitions for the company. So definitely a good medium to long term security. In the short term, valuations fairly valued, recommendation at market rate. So if you have any questions on our segment today, please give us a call at 226-8773. You can visit our website at boursinvest.com or email us at invest@boursefinancial.com if you have any questions. Thanks for joining us today, and do have a wonderful investment week and compliments of the season. Thanks.